Hello, everyone. Thank you so much for tuning in. I am Michelle Shanks with Summit Credit Union, and we are here to present the Home Buying and Refinancing Financial Wellness Workshop. Today's presenter is Dirk Spainhour. He has been in the mortgage business for over 28 years. We have been grateful to have him on the Summit team for a little over 10. And he is what we consider the guru of mortgages. And he's going to talk to you about home buying and refinancing. So I'm going to allow him to have all of the time. I'm not going to take up too much, but if you have any needs, any concerns, feel free to contact us at summitcu.org. That's SUMMIT. C as in cat, U as in unicorn.org. We will be happy to speak with you, talk to you about any concerns that you may have. And if you are interested in a credit union, let us know. But I'm going to let Dirk take it away.
Thank you, Michelle. Welcome, everybody. And today we're going to talk a little bit about mortgages, refinancing, and purchases. Right now in the industry, it is a wonderful time to be shopping for rates. I'd love to tell you it's a wonderful time to be buying, but there's not a lot of inventory out there. So it's a little bit slow as far as the buying process. Refinances are booming and keeping me busy. As you can tell, if you can see anything around, I am in my office today doing this live for you. We'll cover purchasing loans, choosing the right loan. There's quite a few different products out there for you. We're going to be talking about refinancing. Is it beneficial? Is it going to do what's right for you? And finding the programs that best meets your needs. So we're going to start moving along in this, and I'm going to jump over. Michelle, you're going to have to control for me. There we go. We're going to talk about the benefits of home ownership. When you're buying a house, there's a lot of pride that comes in with owning your own home, having your own land, your own house, and being able to support yourself through that. When you buy a house, you also build wealth. A lot of people don't realize this, but the equity you have in the house, and equity, by that I mean what the house is worth, what your land is worth versus what you own on it. The more wealth you gain, the more buying power and refinance and options you tend to have. So it's a great thing to build wealth in it. You also have great tax advantages in owning a home. You can write off interest on most loans that are home loans. As far as a first mortgage, always check with your tax preparer before you do a second mortgage or a equity line to see if that interest is tax deductible. Also, you gain a sense of the community. Most people, when they buy into a home, they're buying into a community. You tend to support local businesses. You tend to support local schools, local entities. You become in the community, just living there and getting to know your neighbors and relying and trusting each other, and just gain a sense of being. And then a personal achievement. You would not believe in my career how many people have come in and they've talked to me about buying, or they're talking to me about refinancing. And, I can't wait I'm excited to get this loan, but I'm also excited the day I pay it off. And I own a piece of my own land. It's just amazing what I hear, how many people get excited about it and just take a big leap into this just for that reason. And I get excited about it. People come up and they see the smiles on their faces. And I love to help people get in those homes and refinance them. Go ahead, Michelle. We're going to jump one more screen. We're going to talk a little bit about both of them still right now, but I'm going to kind of focus on refinancing on this next slide. The big question is, now the right time. Right now with rates, it is. Rates are within 0.25% of all-time lows. I get excited also when people come up and say, hey, is rates really that good? In October of 1989, we were doing a paper, or what they call conventional loans, at $12.99 on a first and $17.99 on a second, and we were 2 weeks out to get an appointment with us. Today, the 30-year fixed rate was 2.875, and the 15 was 2.375. So I think it's a great time to be refinancing and buying. Tax values have been stable for the most part. We are seeing on the refinance market, a lot of the counties here in North Carolina are changing their tax rates or reassessing the values of homes because the values are climbing drastically. And due to COVID, a lot of your counties and municipalities are running low on funds, so they've got to supplement it somewhere. Unfortunately, it is going to hit the mortgage the home ownership people a little bit harder than others, but it's still a very, very small amount for what you're going to be gaining. Again, we go back to the low interest rate environment. And I want to kind of jump back up on climbing home values. Values over the last 2 years have probably went up anywhere from 10 to 35% in most neighborhoods. You have some pockets that have not went up that much, and then you've had some little pockets that's went up even higher than that. So the climbing values is something we're probably going to see for about another 6 months guaranteed. It may level off a little more. The builders get out and can put some more houses up. But right now the values are climbing because there's a high demand for existing houses. On a refinance though, when you're trying to determine if it's a right time or not, there's a thing that your closing cost, if you're doing what's called a rate term, or you're just trying to refinance to get a lower interest rate and reduce your payments, what I like to look at is your closing cost. There is closing cost involved in refinancing a loan. You're going to have attorney's fees. You're going to have appraisers fees. You're going to have local government recording fees. Your lenders tend to charge what's about standard in the industry is a 1% of the loan amount origination fee. There's doc prep fees to get the packages ready for you. So there's quite a few fees involved. But what I like to look at is, are you going to be able to recover your closing cost with the savings in the loan within a 5-year time frame? And what I mean by that is, if you have $3,000 worth of closing cost that's added to your loan, but you're going to save yourself $100 a month, how long is it going to take you to recoup that closing cost? If you can recoup it in less than 5 years, that's a good thing, and it's probably worth your while to do it. If it's going to take you 6, 7, 8 years to recoup your closing cost, that might not be the loan for you. So what we like to do is kind of do those numbers, run them, and see how they come out. And we usually tell a lot of our people that come into Summit Credit Union, if you're saving enough money to recoup that closing cost, we need to go ahead and look at doing this. I'm ready for the next one. And so that's kind of what we want to do for you. Closing costs. What is it going to cost? The industry standard is roughly about a median of 3%. Sometimes it's low 2s, sometimes it's in the high 3s. But usually we try to tell somebody, hey, look at that. And it's industry standards about 3%. There's another thing that goes on in the mortgage industry that a lot of people are not aware of. Low cost and high rate versus high cost and low rate. What some of your lenders may do, instead of offering you, earlier in this presentation, I said that the 30-year fixed rate was 2.875 today. You may call XYZ Bank down the road and they tell you it's 3.25, but when you talk to them about closing costs, they may not charge any or very little closing cost. Over the life of the loan, if the difference in the rate is more than about a quarter or 0.25%, it's really cheaper to take the lower rate and pay a little more closing cost, or pay the closing cost, because you're going to take and save it over that interest rate over the life of the loan. Now, if the rates are very, very similar and you can get it with no closing costs, by all means, you need to take that rate and that with no closing costs, but it needs to be a very, very close relative number for that to be worth its while. I am sorry about something that just popped on my screen. Financing your closing cost. You cannot do that on a purchase. You can on a refinance. They add, if your loan needs to be $120,000 and the closing cost is $3,000, then most of your lenders will let you do a $123,000 loan. And that way you don't have any out-of-pocket costs. There is some limitations to that, so always check with your lender to make sure that you can do it. Upfront fees on a mortgage, typically the only ones we're seeing in today's world is either some companies will charge a fee to get a credit report, but the only other one you should normally see is for an appraisal. And most of the time they put that appraisal on hold using that, put the money on hold to order the appraisal. The appraisal on refinances, a lot of the times is rolled into the closing cost into the loan. So you end up getting that money back. On a purchase, it has to be paid whether you or the seller pay it. So that's usually derived right before the closing, and the attorney distributes the monies as needed. The credit report is some cost. We're not seeing it as prevalent as we used to. Here at Summit, we do not charge a credit report fee, but there is a few private lenders that still do that. Other costs you may see, as I mentioned earlier, recording fee at the county, attorney fees, there's a thing called title insurance. A lot of people don't understand that protects you against prior issues on the title of the property you're buying, or in some people's case, prior issues on a house that you've owned that you may not know that someone has put an easement on or tried to put easements on. So there's all kinds of little things like that that may pop up. There is one that's starting to become very prevalent in our industry, is employment verifications. We have to verify, every mortgage lender verifies your employment right before you buy or refinance a house. And most of your employers now are no longer doing it, and they contract it out to a third party that charges a fee. So most of the time you are seeing that in your closing cost fees. So that's kind of a little bit of what it's going to cost. We also like to talk about your payment. What is included in your payment? In the industry, you may hear somebody say, what's your PITI? PITI, principal, interest, taxes, and insurance. The principal amount is the amount that goes to reduce your principal loan balance on each payment. The interest is the amount of interest you pay on each payment. The taxes is the local real estate taxes. And the insurance is your homeowner's insurance that they break down. And the last two, taxes and insurance, you may hear the word escrow. I do want to kind of go into principal and interest for just a moment. Mortgages are a simple interest loan, which means that the principal and interest amount, the interest amount that is paid on each monthly payment is derived by multiplying your interest rate times the current balance times the number of days between payments. So the more you pay earlier in the loan and reduce the balance earlier, the more money you save. So if you pay extra early in the loan is the best time to throw that out there and get that balance reduced, because you'll pay less interest on it. The taxes is determined by your local county, so your lender doesn't have a say in that, just like the insurance. There is a fifth option that may make up your payment, or a fifth entity that may come in and show, is called PMI, or private mortgage insurance. If you do not put a certain amount down, certain loans have a private mortgage insurance on there to protect the lender that something goes wrong with that loan. It also protects you as a consumer by, if a loan is foreclosed on and they do not sell the house for what's owed, the lenders can go back and put a judgment against you for that amount, and it protects you against that judgment. So at the bottom, when we're talking about mortgage insurance, you need to always ask your loan officer, will my loan have the PMI or mortgage insurance? And they will tell you right up front. If they can't answer that question, you may want to find another mortgage lender. So the big thing in today's world, as far as the individual or couple go, your credit. How's the credit? You need to have your credit and credit scores as good as they can be before you start this endeavor. In today's world, the conventional loans, the ones you hear about on television, the Fannie Mae, the Freddie Mac, they like to see 670 and above on your scores for those loans. FHA wants to have 640 and above. I am going to make a side note that has recently been brought to our attention. FHA will do loans below 640. However, you have to put 20% down, and it is on a case-by-case situation. So if you're buying $100,000 house and you're less than 640, you're looking at needing, you got to look at $20,000 plus closing costs. And that's a lot of people don't have that these days. So 640 is what I tell everybody the magic number is. We also looked at debt to income ratio outside your credit, because your credit is affected by that ratio. The more monies that you have tied up on how much you have borrowed affects your credit score. Now, national standard on your debt to income ratio with all your debts, such as car payments, credit cards, student loans, personal loans, and your new house, or in the case of a refinance, your current house, they want to keep you at 43% of your gross monthly income. And that is your base income. That is not overtime. That is not bonuses. That is not commission, except on commission if you've got it over the last 2 years. Right, currently, you cannot get a refinance or a purchase if you've had a mortgage delinquency in the last 12 calendar months. So if you had a mortgage delinquency in May, as of today, in May of last year, I couldn't do it. But if you had it in June, if we had it in April of last year, then I would be able to do it today. No bankruptcies on some of the programs as early as 3 years, and it drops off after 7 years. Foreclosures, some of them are as early as the last 4 years. Some of them are now looking at 7 years. So you kind of go, those are on a case-by-case basis also, and depending on what happened in the bankruptcy and in the foreclosure. This next screen is basically for a purchase only. There's a thing called a pre-qualification and a pre-approval. Realtors, when you're wanting to buy a house, are going to want to see one of these two letters. It's usually anywhere from 2 to 3 pages, and it'll have a lot of information about you, what you qualify for, and what you're going to need to provide to keep the process moving. A pre-qualification is you just basically provide the lender with some assets and income that you may have, plus some debts. You kind of tell them. They do. Some pull a single credit reports, most don't. And it states that you qualify for a certain amount, but it is not a commitment. And there is no assurance that you're going to get that loan with a pre-qualification. Personally, here at Summit, I try not to do them unless someone forces me. I just do not believe in them because it leaves too much room for a problem to happen for you as a borrower. The pre-approval is the way I like to go and the way I try to get our members to go, simply because it eliminates a lot of surprises and a lot of issues. It's a thorough review that is done with your credit history and your earnings and employment history. And we cannot make that more simpler, and it is a wonderful thing, because if we've got that eliminates those issues. The lender, using this particular pre-approval, will pull a tri-merge mortgage report and eliminate that issue. So unless something happens after that time, you've just taken care of 2 of your major issues. They will provide a letter with detailed information, telling them the amounts and the items you need to provide to make sure that you continue to qualify for the loan. And most people, once you get that document, as long as you can provide the other items they have asked for and the house appraises for what you're paying for, you should be good to go. We're going to jump heavy now kind of into the refinance process. All right. In the mortgage world, you got your conventional and your FHA typically is what is used for refinances. Certain individuals in the military can look at VA loans, which is not a bad item. But most of them, about 90% of all refinances are conventional at FHA. I want to tell you the difference between the two right now. Conventional loans are a great loan. That is the ones you hear about on TV for Fannie Mae, Freddie Mac. Conventional loan, if you are over 80% of the current value when you do your refinance, you will have PMI insurance. When you get below 80%, that PMI insurance will go away. Okay. So, after maybe a couple years, or maybe even shorter than that, you may end up getting a little more savings. FHA, they have 3 different rules that apply. If you're greater than 90%, the PMI will never go away. So if you refinance and your refinance amount is, sorry about that, if your refinance amount is greater than 90%, you're going to be paying that PMI forever. And there's no benefit to you once you get to 80%. If you're over between 80 to 90, it's going to be on there 13 years. If you're less than 80, you're going to have it for at least 11 years. That changes pretty much once to twice a year. So always ask, if somebody tries to put you in an FHA refinance, always ask how long of the PMI insurance going to be on, because it will be on an FHA loan. Also, to get started, we want to see the application. That just changed as of March. There's a whole new application that we as lenders are required to use. It is nationwide, so every lender uses the same one. At that time, they will get your credit and they will start the loan approval process. Once they get the loan approval, then they start gathering documentation about your income and homeowner's insurance, all the items that go along with it. They do order the appraisal. Once you've gotten everything in, the appraisal, the title work from the attorney, and the documentation they've asked for, it goes into underwriting to get your final approval, get you to the loan closing. I do want to tell you right now, from Summit Credit Union to every lender in the nation, it's a process right now. It is a slow process. Everybody's behind for quite a few reasons. COVID has cut down on the number of appraisers that's going into people's homes. It's cut down the number of mortgages that the attorneys can close per day. And take that with the fact that we've got the lowest interest rate environment basically in the history of the United States. It has backed the process up. Some companies are 45, 60 days, some are 120. There is a big national lender that's over 120 days to get a loan closed right now due to volume. Always check with your mortgage originator or processing team and get an idea of how long it's going to take. This is Dirk. This is me. You call me. It's got on this presentation, it's got my direct line. It's got my email address. No question is crazy. If I come to someone's job that I've never done, or I've never took part in the process, I'm going to have a lot of questions. Feel free to call or email me, reach out to the credit union. We'd love to help. Have a great time doing this and look forward to dealing with you guys, and hope we get to do this again soon.